You ever notice that money gets treated like it's one thing? A dollar is a dollar, cash is cash, money is money. Simple. Except it isn't. Because in the financial system, money is more like a pyramid of promises. At the bottom, there is the money you can touch. Above that, the money you can swipe. Above that, the money you can claim. And above that, the money that starts sounding like a magician's trick performed by a banker in a very expensive suit. Today, we are walking through M0, M1, M2, and M3, the money supply pyramid, in plain English, with humor, with depth, and without turning your brain into mashed potatoes. Because once you understand this, you stop looking at the economy like a mystery and start seeing it like a layered machine built on liquidity, trust, and time. And yes, by the end of this video, you will know why the money in your wallet, the money in your checking account, and the money in a giant institution's books are all called money, even though they are not equally spendable, not equally liquid, and not equally real in the same moment. Welcome to the pyramid. What money supply even means? Let's begin with a deceptively innocent question. How much money exists? Sounds easy, right? Wrong, because the answer depends on what you count. Do you count only physical cash? Do you count checking deposits? Do you count savings that can be moved quickly? Do you count large institutional funds? Do you count assets that are money-like but not money in the buy a sandwich right now sense? That is why economists use different layers of money, called monetary aggregates. These measures get broader as you move upward. The Federal Reserve describes M1 and M2 as progressively more inclusive measures of money. M1 contains the most liquid forms, currency, demand deposits, and other liquid deposits, while M2 includes M1 plus certain less liquid savings-type assets. So think of this as a pyramid of spendability. At the bottom, money that is immediately usable. Higher up, money that is still close to spendable but requires one more step. Higher still, money that behaves like money in markets but not in your pocket. The higher you climb, the more the word money starts to mean not cash in hand, but a claim that can probably become cash soon. And that, my friend, is where the plot thickens. M0, the foundation, the primal money. Let's start with M0. M0 is often used to mean the base money or base money. In practical terms, that usually means currency in circulation plus reserve balances at the central bank. Fred's Federal Reserve data notes that the U.S. monetary base equals currency in circulation plus reserve balances. Another central bank framing says base money includes currency plus central bank reserves, the money only the central bank can create directly. This is the bedrock. This is the source layer. This is the money that sits closest to the central bank's printing and reserve machinery. Imagine the economy as a giant city. M0 is the concrete, the steel, the water mains, the electrical grid. Without it, nothing else stands. It includes physical cash in circulation, bank reserves parked at the central bank. Now here's where people get tripped up. When people say the government printed money, they often imagine trucks full of paper bills exploding out of the mint like confetti at a billionaire's birthday party. But much of modern money creation is not about literal paper. A major part of the base is reserves, balances commercial banks hold with the central bank. So M0 is not just cash. It's cash plus the central bank grade money that commercial banks use inside the plumbing of the system. That's why M0 is narrow. It's the root, the seed, the royal bloodline. It's not all the money people can spend. It's the money from which broader money measures are built. Think of M0 as flour in a bakery. You don't eat a sack of flour for dinner, unless life has gone terribly wrong. But without flour, a lot of bread never exists. M1, money you can actually spend now. Now we step up to M1. This is where money becomes more familiar. The Federal Reserve says M1 consists of the most liquid forms of money, currency, demand deposits, and other liquid deposits.
Other liquid deposits includes accounts like NOW, ATS, share draft, and savings deposits under the current U.S. definition. So M1 is basically money you can use quickly for transactions. This is your spend now layer. If M0 is the hidden machinery beneath the city, M1 is the traffic on the streets. This includes cash in your hand, money in checking-like deposits, and other highly liquid deposits that can function quickly as payment balances. Now pause right there, because this is one of the biggest mental shifts in finance. A lot of the money you use every day is not paper. It's deposit money, digits, entries, claims on a bank. Your bank balance feels like cash because it's highly liquid. You can tap your phone, swipe a card, make a transfer, pay rent, buy lunch, donate online, order socks at 2:11 a.m. because modern civilization has made impulse purchasing a spiritual warfare issue. That's M1 territory. The key concept here is liquidity. Liquidity means how quickly and easily something can be used for payment without significant loss of value. M1 is the closest thing to everyday money. So if M0 is the skeleton, M1 is the body moving around town. And here's the subtle twist. M1 is broader than M0 in a functional sense for the public because it includes deposit-based money people actually transact with constantly. The Fed explicitly frames M1 as the most liquid forms of money available for transactions. M2, money plus near money. Then comes M2. This is where the pyramid expands from money to near money. The Federal Reserve defines M2 as M1 plus small denomination time deposits and retail money market fund balances. So M2 is basically money plus assets that are not quite immediate transaction balances, but are still fairly liquid and often used as short-term savings vehicles. A Federal Reserve research note describes M2 as broader than M1 and containing components less liquid than M1, often used for short-term savings. So think of this as money plus money that is one step away from being money. This is your almost in your hand category. Picture your house. M1 is the cash in your pocket and the money in your main checking account. M2 is that plus the money in the nearby drawer labeled savings, short-term reserve, don't touch unless necessary, or vacation fund that inflation keeps nibbling on like a goat with a grudge. It's still your money. It's still relatively liquid, but it's not always sitting in the exact form you use at the cash register this second. That matters because broader money measures often tell us something about spending power in waiting. M2 is a bigger view of the economy's liquid wealth pool. If M1 is your warrior on the battlefield, M2 is the army plus its supply wagons. Not all of it is firing arrows right now, but it's close enough to matter. Scene 5. So where does M3 fit? Now we climb into the mist, M3. Historically, M3 referred to an even broader measure beyond M2, including larger and less liquid institutional forms of money-like assets. In the U.S., the Federal Reserve stopped publishing M3 in 2006, explaining at the time that M3 did not appear to convey additional information about economic activity that was not already embodied in M2, and that the costs of collecting the underlying data outweighed the benefits. So in modern U.S. practice, you usually hear more about M1 and M2 than M3. But conceptually, M3 still helps people understand the pyramid. If M2 is money plus near money, M3 is money plus broader, larger-scale financial balances that are money-like, especially in institutional contexts. This is the altitude where ordinary people start blinking, because M3 is really not about how much money can I spend at the grocery store. It's more about how much large-scale liquid funding exists in the broader financial system. If M1 is your kitchen cash jar, M2 is your household plus savings, M3 is the whole neighborhood, the local businesses, the storage warehouses, and the giant distribution centers humming in the background. It's broad system liquidity. It's the whale layer. It's the people moving this money don't buy one coffee, they buy the coffee company layer. And that's why the pyramid matters. Not all money lives at the human scale. Some of it lives in the architecture of finance itself. The pyramid, visualized, simply. Here's the simplest way to remember it. M0 is base money, M1 is spend now money, M2 is M1 plus near money, M3 is very broad money, especially large or institutional money-like balances. Or even simpler, M0 is the central bank foundation, M1 is cash and transaction-ready money, M2 is M1 plus short-term savings type money, M3 is the broad outer halo of large money-like balances. This is not just a ranking of quantity, it's a ranking of liquidity and distance from
immediate spending. The farther up the pyramid you go, the less direct the money becomes. Not fake, not imaginary, but less immediate. And that distinction is everything. Because in a crisis, people suddenly remember a very old truth. It matters whether your money is in hand, in checking, in a savings vehicle, or tied up in a larger financial claim that needs conversion. In calm times, all these layers feel friendly. In panic, everybody wants the lower layers. That is when the pyramid stops being academic and starts feeling like survival. Why this matters in real life. Now somebody says, "Cool story, why should I care?" Because this pyramid explains why economic headlines can sound weird. For example, a central bank can expand reserves. That affects the base, but it does not automatically mean every person instantly has more spending money. Banks can hold reserves. Households can save instead of spend. Financial conditions can tighten even when some monetary aggregate rises. The layers matter because the transmission from base money to everyday economic activity is not mechanical. Central bank money, commercial bank deposits, and broader liquid assets play different roles in the system. This is also why people get confused when they hear, "They printed trillions." Sometimes that refers to expansion in the central bank balance sheet or base money conditions. Sometimes people mean broader growth in deposits and money supply. Sometimes they mean deficits. Sometimes they mean all three at once, while arguing on the internet with the confidence of a medieval king who just discovered podcasts. But the categories are different. And if you do not distinguish them, you will mix up reserves, cash, checking balances, savings-type balances, large institutional liquidity. That's like confusing water in the reservoir, water in the pipes, water in the bottle, and water futures on a commodities exchange. They are related, they are not identical. The big reveal. Money is trust, organized by layers. Here's the deep part. The money supply pyramid teaches something almost philosophical. Money is not one object, it is a hierarchy of claims. At the bottom are the most final, most liquid forms. As you rise, you move into forms that still function as money, but increasingly depend on institutions, convertibility, and confidence. That's why the system works when trust is high, and why everyone suddenly becomes a philosopher during a banking scare. Because then the real question is no longer how much money do you have, it becomes in what form. Cash, bank deposits, savings products, money market balances, large institutional claims? The answer matters a lot. Because the pyramid is not just about money, it's about how close you are to final payment. And final payment is where all jokes end. So let me tell it like a legend. Imagine a kingdom. At the center sits the sovereign mint and reserve chamber. That's M0, the crown's base money. Then the merchants fill the markets with coins and instantly spendable account balances. That's M1, the money of daily life. Then the households, guilds, and prudent families keep stores of value in nearby chests, redeemable with little delay. That's M2, savings standing just behind spending. Then, above the visible city, giant houses of finance move mountains with ledgers, instruments, and large liquid claims. That's M3, the empire-wide money shadow. One kingdom, 4 layers, different distances from the marketplace. And the genius of the whole system is that people casually say money while standing at completely different levels of the tower. That's why 2 people can argue about the money supply and both sound right for 5 minutes. They're talking about different floors. So the next time someone says money supply is up, don't just nod like a decorative plant. Ask which money: base money, transaction money, near money, broad institutional money? Because M0, M1, M2, and M3 are not random economist alphabet soup. They are the map of the modern monetary world, a pyramid of liquidity, a ladder of claims, a hierarchy of trust. And once you see it, you can't unsee it. You realize money is not merely paper, not merely digits, not merely accounting. It is a structured system of access. Access to spending, access to saving, access to settlement, access to power. And in every age, whoever understands the layers of money understands more than finance. They understand the architecture of civilization itself. If this video made the money supply finally click, drop pyramid in the comments. And if you want the next one, I can do how banks actually create money, or why inflation hits before most people understand it. Subscribe, because we're going deeper. Not into conspiracy, into structure. And structure is where the truth likes to hide.